So when I'm looking at price action, okay, if you're not going to pay attention to this kind of discussion, if it doesn't interest you, if you don't like going into the details, I promise you everything that you study under me will frustrate you. It's not meant to be easy because it's very technical. But what I'm going to explain to you here is very generic approach to every single time I'm looking at price action. My mind frames out a specific area in price action. See, when you look at this chart, you're looking at all of these candlesticks and you're looking back. You're like, okay, where's there a fair value gap in here? Where's there relative equal highs? Where's there a wick over here? I'm not doing that. I'm not doing that at all. That's not what I'm doing. So what I'm doing is I want to say, okay, first, if the data range is 20 days look back, okay, so what would that look like? What would that constitute as a beginning and ending point? So that way you have a very easy framework to start and hit the ground running this week. That way you can go and start using this information yourself. We're on Saturday. Okay, it's October 18th, 2025. It's a Saturday. The markets are not trading unless you're a crypto freak, and I'm not trading crypto, so I could care less. So this is looking at the close on Friday. Okay. Count that day as one. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. So right here, September 22nd, that's 20 days look back. Now, inside that range of 20 days, what we're going to look at is the highest high and the lowest low. Very, very simple. It's not complicated. It's not ambiguous. It's very specific. So what would that be? This is the lowest low, and this is the highest high. So in deference to those two price points, there's the 22nd, and the candle right before it's the lowest one. In all of these ranges up to that high, this is the lowest one. So all you're gonna do is drop a box on that, anchored up there, and this is just for visual representation. You don't need to do this because it's just lipstick to help me communicate something to everyone that's watching. But inside this range, that is my 20-day look back. That's all I ever need. I don't ever need to look to 40 days or 60 days. Now, if you're in a market that's running, for instance, like gold, and we'll talk about gold in a little while. But if we're looking at just tell me what the market needs to be focused on right now, what PD arrays are going to work right now, which one's the central focus, what draw on liquidity is the ones that I need to be worrying about right now. Give me the right now skinny ICT. Make it short and sweet. I ain't got time. I'm only 20 years old. I ain't got this all the time in the world to learn all this stuff. Okay. This is what I'm looking for right here. This is my bread and butter when I'm real quick, kind of like sitting on the sidelines, waiting for something to pop up. My go-to is this. So I want to go back over the last 20 days. If it's a market like gold, I almost went over this without saying it. If it's a running trending market like gold is, okay, or silver, something like those markets where they're going parabolic, then I'll go back 60 or 40 days and I'll get the range there. Okay. And what I do is I want to see where are we in relationship to that range. Now, obviously, right now we're in the premium side because we went down to discount below. Here's this dark line here. That's 50% of that line. And you get that by having this middle line toggled on the rectangle tool. I don't mean to bore you, but I get a ton of questions. So I kind of like want to take these moments to put that kind of stuff in there because hopefully it'll reduce the number of questions I get that are repeated or redundant or seeming very elementary. And some of you guys get really offended when other people ask questions like that, on X. And it's almost like you're creating an atmosphere where no one wants to ask a question, which that pisses me off when I see that. So remember, you didn't know this shit the first time you sat down either. So at this line or above it is premium, or at this line below it is discount. Okay. So having all these reference points inside this range available to me, I first start fresh by looking at where are we in the range of that segment of price action. And I'm gonna okay, I'm just gonna plot it over top of this. It's already got a lot of stuff on it now, but just bear with me, okay? And everything will be in a black, bold line. And it's gonna represent the grading of that 20-day look back. And again, this is for everything that I ever would ever want to trade. If it's Forex, if it's stocks, if it's commodities, bonds, index futures, whatever. Okay, whatever I'm doing an analysis on, this is the very first thing ICT does. The very, 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 very first thing. Okay. Part of the things that I have written down, hear that? This is that little yellow notepad I tell you I always have. I have these levels when I'm looking at a particular market, or if someone prompts me, hey, look at this, the first thing I do is what I just did here. I grade the price swing or the range of the last 20 days. And then making sure that I have the full grading levels. By having this, it tells me where I can focus in on very high probability shifts in market structure, where it can draw down to as a retracement, and what PD arrays lie inside of each one of these quadrants. Because every one of these quadrants also can be graded. So that way you have a 20-day look back like this. Let's say there's upper quadrant, like not the highest upper quadrant, but this one here, but it's in a premium. Then we have equilibrium, and in the lower, below the midpoint equilibrium, but not the lowest. So the extremes, when we get into these areas here, when we have a 20 look back that's bullish or has been moving higher like that, unless I'm expecting a complete reversal or basically a bear market resuming, I'm not looking for anything in this lower area down here. My focus is going to be primarily in this area here and this area right in here. All the setups, all the things you're going to look for that are many times just actionable PD arrays that you can just get in there and just take a trade on intraday. 15-second chart, 5-second chart, 1-minute chart, 5-minute chart, 15-minute chart. You're going to see all kinds of busyness available to you as a short-term high frequency trader. And forego the idea that it needs to get down this extreme lower quadrant. Okay, and I'll give you all the boring details about that, at another time, because if I did that here, it would fill the whole hour up. But this is what I'm doing, and I have these levels by price: 97.215, 97.802, 98.389, so forth. I have that written down on my little notepad. Okay, now inside of all these quadrants, there's going to be PD arrays. Okay. And those levels with their respected grading levels, I have those in order. So inside this little notepad, on whatever page I'm looking at, like right now, I have NASDAQ. This is the one I'm focused on primarily. If this were dollar on my pad, and I want to share everything that I want to give to you, is not everything on my pad, because I'm not hiding anything from you, but it's just I want to keep things personal. You know what I mean? And I don't feel comfortable sharing everything. Not You don't need to know every detail, but I am telling you what I'm writing down. But every PD array in here and its respective quadrants, like this wick in here, I would have that written down below this price level here, and it would all be listed from the highest to the lowest of what I'm looking at. And then I'm watching price. I only put things on my chart when I'm recording, if I'm doing a trade. All that stuff's being put on the chart so you can see it working. I don't look at that stuff when I'm watching price. I'm looking at price completely and utterly naked, and I'm watching just where price is at over here on this price axis, keeping track of time. That's how I'm trading. You think I'm looking for these boxes to be touched. I'm watching it visually. I don't need to see them painted over top of price action. In the beginning, you will probably use that as a useful tool or crutch. And I don't mean that to be derogatory. It just means that You may outgrow it. Don't feel that you have to. Don't feel like, well, ICT said this, so therefore I got to do that, or I'm not going to be a good SMC or ICT trader. Unless I can do it like him, then I'm not really equipped. That's not true. I'm just telling you, because of my necessity for keeping a chart clean, having nothing on the chart at all, it allows me to have the opportunity to see something fresh on the chart that otherwise might not be so obvious, because there's a lot of things already on this chart here, which is very busy for me. Like, I don't ever have something like this on my chart. And this looks like stuff you see on TikTok or Facebook or everywhere. I don't have that kind of stuff on my chart. But as a teacher and showing you how it is I'm calling these moves before it happens and turning it on a dime and goes right to this tick and stop, I have to give you the visual tools to see what it is I'm pulling out of price action and what segment of price action I'm referring to. So don't be afraid to I guess, warm up the idea that you have to do well, use this level of annotation on your chart. If it's comfortable for you to do that, then by all means, there it is. But I personally want to give myself the ability to recognize when there's nothing on my chart, if there's a new PD array forming that I didn't notice it. And like I said, I have 53-year-old eyes, and they're not as strong as they used to be. And sometimes I'll draw a box when I'm trying to show you all, and I may not see a volume imbalance because my eyesight's poorer than it was just 2 years ago. And it's not intentional. I'm not trying to cause confusion. It's just that's just a frailty at my age right now, and I'm in between eyeglass prescriptions, and I don't want to get them yet until the end of the month. So we're looking at this range here, and inside of this portion, okay, 75, 50 to upper 25%. That is where the heart or the core of most of everything you're going to see that's useful to you, it's going to reside inside that. So that way you can ignore this area for now until it comes all the way down to the lower quadrant and breaches on a closing basis. You need not concern yourself with anything down here. That's how I'm interpreting price action using a 20-day look back. So I'm focusing primarily on just this bit of business in here. Okay. So with that said, we're going to remove this now, and I'm going to remove this box and go back to what I had here. Okay. So now you know what that looked like. I'm not going to give you a PDF of this stuff. So the way you can do is watch the video, pause it, and then do a screenshot. Okay. And there's your equivalent to what I would be putting in a PDF. I don't have the time today to do that. I don't mean that to be curt to anyone, but everything that would be done in a PDF file, you can gather it from this video. Okay. So we were up here, and I told you if it went down to this level here, then it would offer the opportunity for NASDAQ to go higher. And when we're up in this level here, using that idea that showed you on the 20-day look back, it allows you to frame a very specific segment of price action. So your focus is narrowed to what is the most salient range of price action that the algorithm is going to refer to at the moment. 20 days look back. By grading that, you can see where the upper quadrant and the lower quadrant, in deference to the equilibrium price point, inside that little area, or maybe not necessarily a little area, it could be a broad, big area, but inside that smaller portion of the last 20 days look back in dollar, all of that is going to be the heart of what the market's going to utilize. And you need not concern yourself with anything beyond that. So do you see how right away we're already reducing the argument down, okay, and distilling the principle of focus. When everyone outside of our community, they'll say, well, this stuff doesn't work. Um, it doesn't it doesn't make money. You can't use it. It's not predictable, and there's too many of them, and there's a lot of them that fail in terms of fair value gaps or PD arrays. By limit your focus to the upper quadrant and the lower quadrant in the last 20 days, whether the market's moved higher or lower, you are now focusing in on where every single one of the high probability PD arrays are going to form. Do you see the advantage in knowing that now? Every single time you sit down in your charts, and what will be interesting for you is by you going back and back testing. How would you do that real quick before I go on further? Let's say that you were doing this, okay, and you look back. This was the 20-day look back range here. But you want to do another research approach to it. Well, just move further over to the back of the old price data and just pick any random day and start there and say, okay, I want to do a case study here. Let's say I was looking at price action here and count that as day one and go back 20 days and frame it and grade the range from the highest and the lowest and then see where you're at and look at the upper quadrant and lower quadrant. And you're going to see everything that's being used is inside those very specific ranges. So that's what the algorithm's doing. It's cycling through on a daily chart in that range, highest and lowest, because it's an algorithm. That means it has to go back to a very specific data point. If anyone that's ever studied computer programming, it would be beneficial, honestly, if frame and back testing. How would you do that real quick before I go on further? Let's say that you were doing this, okay, and you look back. This is the 20-day look back range here. But you want to do another research approach to it. Well, just move further over to the back of the old price data and just pick any random day and start there and say, okay, I want to do a case study here. Let's say I was looking at price action here and count that as day one and go back 20 days and frame it and grade the range from the highest and the lowest and then see where you're at and look at the upper quadrant and lower quadrant. And you're going to see everything that's being used is inside those very specific ranges. So that's what the algorithm's doing. It's cycling through on a daily chart in that range, highest and lowest, because it's an algorithm. That means it has to go back to a very specific data point. If anyone that's ever studied computer programming, it would be beneficial, honestly, if most of you had that background, even if it was a simple basic language, okay? Just knowing that a computer program needs to have it needs to have data. It needs to have something to generate an output from. And that is simply a data or an array of data. So where would this algorithm or computer program get that information? Well, if you say you're a computer programmer and you were going to do payroll for a company, you're creating a program or computer program to generate a payroll um, report. Well, you have to be able to go through the time punched in, the time punched out for every employee for each day, and then calculate their hours of start to end, total hours worked, and then you do all of the necessary calculations for the state and local tax and the federal tax and any kind of deductions or whatnot, and then it spits out that report and says this is what the company paid this employee, and it would do it for every single employee. Well, how does it go to that information? By date and time. You see? So when you're looking at price algorithmically, that's why it's silly. I don't understand why everybody is so constipated about the idea of these markets being rigged, because you should be thankful that they are rigged. Because if they weren't rigged, I couldn't do this. Nobody could do it. Nobody could absolutely figure this out. I should have brought my other chair. This dining room chair is uncomfortable. By having the reference to time, we can look back 20 days, highest high and lowest low, and then frame where in that range the algorithm is going to focus on primarily to use specific data points. On a daily chart, every individual day and its open, high, low, and close is a specific data array. It's a reference point. Now, what do you think happens when the algorithm is looking when we're up here? It's going back through all of this range. And we knew that this area in here is essentially the upper and lower quadrant, not the lowest extreme quadrant and not the upper extreme quadrant. It's just the middle part. Okay. While it's up here, if it's going to go back through every individual candlestick, it can determine, like this candlestick here, this is a premium wick when price is right here. If it's going to reprice lower for the purposes of allowing other markets to go up and create a risk on environment and trade to a deeper discount on its individual daily range, it would not use this candlestick premium wick because it's already below it and it plans to go lower. It's generating more delivery to the downside. So it's going to ignore this candlestick wick. But what will it do with, for instance, this wick? This is a premium wick too. Let me move it over so you can see it. See that? So this candlestick's high is delivered with a small little wick. I want you on your own time, take that wick right there and project those quadrants all the way through and look at every small little time frame, see if there's any rhyme or reason to why price maybe have used any of that. Then the next one after this candlestick going to the left, in the look back of 20 days, it's going to be up here and then looking, oh, now look, this candlestick has a daily high and then its close is way down here and its open is down here and its low is a tick or so below that. So you can see visually that there's a long wick on the top end, right? So the algorithm is going to take that entire range of that wick and what's it going to do? It's going to grade it. With that idea in mind, all I did was shrink down the daily chart. The open, up, and high. You don't need to be able to, um, I guess, have the 20 and I'm sorry, 25 and 75, where they're at, if it's the high end or the low end. In other words, I'm just real obsessive about it. If it's a wick that goes up and it's a premium wick on that individual candlestick, I always take it from the close up to the high, regardless of wherever I'm using it in terms of a discount or a premium draw. I'm just real anal about that because I have to have these levels on my notepad the right way. And by having them written this way, where it has the 25, the 50, and the 75 here, by having it that way written on my chart, or not my chart, but on my piece of paper, I don't have to have it on my chart. I'm looking at it by its label, its little annotation written next to the price level here, like 93.306. I know automatically because of the orientation of 25, 50, and 75 is a premium wick. So I don't need to write that part down. You see how I'm saving myself shorthand chart on my piece of paper. I don't have to have it on my chart. I'm looking at it by its label, its little annotation written next to the price level here, like 93.306. I know automatically because of the orientation of 25, 50, and 75 is a premium wick. So I don't need to write that part down. You see how I'm saving myself shorthand I'm saving myself longhand writing in notes with shorthand ideas by referencing that. Okay. So referencing specifically if the 25 is the higher quadrant or the lower quadrant is what I'm referring to. And if it's the higher, then it means it's a premium wick on that individual candlestick. And then projecting those quadrants forward, watch this chart over here. Okay, because these levels are going to end up populating over here, and you're going to see a whole lot of things that never were noticed before. See them over here. Now they're showing up over here. Now watch. The algorithm right up at this day, the rules I told you is if it goes down below consequent encroachment and goes below this individual candlestick low, then Nasdaq's going to go higher and dollar will want to go trading lower. And then we'd have to worry about going into this inefficiency and worry about this wick here. Go back and watch the recordings. Okay. Don't take my word for anything I'm saying because I could tell you anything. I could blow smoke up your ass. And most of you would think, wow, ICT said, this, that, and the other thing. So I don't have to do any of that stuff. I can just take what he said and that's all I'm going to do. Just believe what he says. No, don't believe anything I'm saying. Go out there and test it and see it for yourself. Because when you see it in your own charts, you don't need to have to worry about wrestling the idea or defending me on social media for people outside our community. You just let them believe whatever they want to believe. But if it's up here and it trades below that, the algorithm is going to have all these levels immediately because it knows this old day had a high and the close was significantly lower below it. It's open what's below it, and then the low is here. So it knows the orientation. So it knows how to grab this candlestick's high and this candlestick's close. It's a very short little order of coding that's required just to get the idea of each individual time reference. And anybody that's looking at candlesticks that are not time-based, you are literally wasting your time. No pun intended. Because you can't get this information by changing these things to range bars or whatever else nonsense out there. Okay. As soon as you start manipulating and changing the order of where these open, high, low, and close are forming, you are stripping the advantage from everything you're doing. And if you do make money, it's just chance and guess. And if that offends you, I don't give a fuck because that's exactly what it is. You can't come out here and tell us where it's going to stop on a dime. You can't tell us that, but I do. And I do it all the time. And I do it as a litmus test because I don't see anybody else doing that. And you need to warm up to the idea that these markets are using time and it's using it just like this. Knowing this candlestick had a higher premium wick, stripping it down to just the quadrants, the close, the high, and every quadrant that's equal quadrants, lower quadrant, equilibrium, upper quadrant, and the high. That's the price levels that the algorithm is going to refer to. Don't believe me? You don't believe me? Look at the 5-minute chart. Listen, folks. Listen, because some of you already see it. Like, what the hell? Yes, yes, Virginia. There's a fucking algorithm. So we're looking at first the 98.499. Okay, 98.499. That's this level right here. Okay, I'm gonna try to squeeze this area there. Now we can see it. So here at Thursday, the 16th, that's this day right here. Okay, on the daily chart, left hand side. On the 16th, we were above it while we were inside that blue suspension block. It starts to trade down and leaves that blue shaded suspension block. And then here's the high of that wick over here. So it's encroaching on that wick high when we get down to 98.499. Right here, we hit it. We drop a little bit from it, come back up, fair value gap, fills that in, drops. Fair value gap, fills that in, drops. Where's it drop to? 98.402. That's just the upper quadrant of this wick. Trades down to it, creates your little classic bull flag. It works then, doesn't it? It drops down to this equilibrium at 98.306, and then has some kind of random reaction, like a rash, or hives. It starts to bubble up and goes right to some random level, the upper quadrant level, at 98.402. Right away, this should get your rocks off because this is not pivot points. It's not supply and demand. It's not Elliott wave. It's not Wyckoff. It's nothing but mine. Mine, just mine. And I'm sharing this with you because I want you to do these things in your own chart. Because every single meaningful price run, don't take my word for this, every single meaningful, significant, valid price run, and there's always valid price runs occurring all day long, every time frame, they all originate off of this idea. Oh my. Oh my. I just right there leveled the playing field for so many of you. I've watched some goofball sent me an email, said that what I'm teaching right now is nonsense. And my old stuff had some value, but this stuff here is nonsense. This right here is the fucking market. This is the source code. Okay. You take this out of my work, and I'll have retail results. Now, does that kind of exemplify, put a little exclamation point on the importance of knowing this? It should, because this right here is the foundation. It's the spinal column that holds all of the efficiency in price runs using my PD arrays and the efficacy of how I use them and when I select them. Because if you strip this away, there's no rhyme and reason why I would use any other fair value gap or any other PD array, any other order block. There's no way for me to determine which one it's going to use. This is it. This is the thing. This is the sauce. This is the secret. This is the whole fucking shebang, baby. If you understand this, they can never, 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 not a fucking time in the fucking future can they ever hide it from you. They can never fucking hide it from you. Now, can they have some crazy manual intervention where they whipsaw back and forth? Sure, you might lose money on that. You might get stopped out. You might take a big loss. But they can't keep doing that. Every day can't be a fucking seek and destroy up and down this destroyer because nobody will trade then. So if you ever had that happen and you're using my content and you see something just go out of nowhere, like, oh shit, this completely, just wrecked me for this trade. Turn your computer off, wait a day, come back, and everything will go right back the way it was. Now, doesn't that give you peace of mind? It should. So there's no excuse for anybody to lose their mind and completely FOMO, fear of missing out, fear of missing a move, being afraid that you're not going to catch the move, afraid that the algorithm's going to fucking change. I'm not changing shit. There's no need. There's no need. Price trades up to this in here, trades right to the order block that's laying right there. Let me make it a little bit bigger for you so you can see it. See that little up close candle right there? Has a volume imbalance in it. Trades right up into that. It's the open of that price. What's this opening price at? 98.408. The high of this candle comes in at 98.410. So there you go. Hits it. Why does it drop? Because it's an order block? No. It's because my order block is stacked over top of and laying right on that quadrant. What quadrant is this? This premium wick array, upper quadrant, right there. And it drops. Stops dead on equilibrium. And then it stays inside no man's land. Whenever you see price hovering between quadrants, don't touch it. That's when you're going to get burned. That's when your fair value gap is going to not be so pristine, not so helpful. It'll be unruly, and price will trade outside of it and through it. We open lower, trade down to the lower quadrant, this one here at 98 point. Let me show you the price levels over here. 98.20. Oh, I'm sorry, 209 to say it that way. And then trades down to the old inversion fair value gap right here on the daily chart, left hand side. First, let me pause for a second, okay? I really want you to understand something because I already know that I'm picking up on the force right now, okay? The Jedi in me is picking up on the disturbance. I'm picking up on the fact that I have a lot of people in this audience that doesn't fucking deserve me teaching this to them, okay? And I want you to know something. These are the things that I did not want to ever share because it's too fucking perfect. It's too good. And a lot of you 20-year-olds are going to go out there and write books, and you're going to make up your own little fucking mentorships, and you're going to pretend that you found this. You discovered this, or some fucking dead person that never even used this information ever, okay? Or some fucking horse shit that Chris Laurie teaches this bullshit. He doesn't fucking know anything about it. Maybe he's taking notes. Hi, Chris, if you're listening. But the bottom line is this. This doesn't exist anywhere else. It never has existed anywhere else. And I want you to just take a moment and just think, if you knew this and you could do what you watch me do every time I come out here and tell you what the market's going to do, it does it. How is it that I'm picking the right PD arrays all the time? This. Would you share it? You know damn well you wouldn't do it. None of you would. None of you would. You can say, oh, I would. No, you wouldn't. No, you wouldn't. No, you would not. And I'm going to tell you right now, if I hadn't made the arrangement with the Lord above, I wouldn't be doing it either. And I second guessed it in the beginning. But look at the precision in it. Look at it. It's nuts. It's literally insane. But, it is what it is. So the market trades away from this 98.306 down to the lower quadrant, down into the inversion fair value gap again. Bodies are respecting the inversion fair value gap high. Again, that's this area right over here. This candlestick's close to this candlestick's open. That's what I'm shading because this is originally it's a suspension block. But when it trades above it, it's going to invert its characteristic. So it's an inversion suspension block, but it's inversion fair value gap. Suspension blocks are in the category or classification of a fair value gap. So, and there's a couple more you'll learn about in the future, but right now it's just outside the scope of the time I have here. And I'm looking at the time and I'm like, shit, This is not gonna be an hour long. And I didn't intend, it's not trying to be funny, I'm not trying to be cynical or, trying to razz you. I really wanted to get done, and I thought I could, but sometimes I just gotta remind some of you folks that are listening that you are undeserving individuals. Not all of you, just the ones that talk shit or make sock puppet accounts and talk shit about me. But the upper quadrant's used here, trades down into the inversion fair value gap, this shaded orange hue over here. It's doing that and goes down to the low at 98.112, which is this candlestick's close. Trades to it and through it. Okay. Now, when we look at the market when it's in a deep, deep discount, we're looking at this at a time when we're now in the lower quadrant of the last 20 days look back. And we're real close to getting into the meat or middle part of the lower quadrant area. So we want to be referring to where we are on the daily chart, what PD arrays and what levels are there. And you start on your daily chart and then have those levels transposed over into your lower time frame, like for instance, like your hourly chart and the 15-minute time frame. I don't use all those time frames when I'm doing reviews because I would never get through them. The average watch time on my videos is 12 minutes. And that's a testimony to why most people feel it's complicated. Because if you're only going to spend 12 minutes, I'm never going to be able to talk 12 minutes and get it all covered. Ain't no way. Nobody could. Nobody could. Go to physics and chemistry labs and see if the professor can talk about what he's going to teach inside of 10, 15, 20 minutes. Not if he's trying to teach you. You can't. So by having unrealistic expectations, you're deferring the success you can have with this by not submitting to the time that's required to learn and learn properly. But if we're in a deep discount down in here, we start now waiting for markets to indicate a shift in market structure. Here is a big, big light year jump ahead. Okay. And if you like what I'm teaching today, this is the moment where you take a second and go up to that little thumbs up. It doesn't give me any money. I promise you it doesn't. But it tells me that you're listening to me and I'm prompting you to give me a grade. If this is useful information that you can see, wow, this is really precise. I can see how this would really help me pick PD arrays. It would help me determine where the draw on liquidity is, where all this is coming together based on this structure. This is the skeleton behind the PD array matrix. Having all these things documented on your chart is useless without this information. This is the like the decoder ring. Okay, it's the cipher that you use to determine what the rhyme and reason is for the market at this given moment. That's what this is. And I honestly didn't want to talk about it or teach it to anybody because I know you all prostitute and bastardize the things I teach, and you go out there and you hide and pretend you found on your own. And all you're doing is putting a big bullseye on yourself because I've already done this with probably 60 different guys on YouTube and called them out saying, this is my information. And they lost tons of business because all their subscribers saw that they're bullshit and it's my content. And they can come here and learn for free, as it should be. So when we anticipate a market potentially going into a shift higher after it trades down to a deep discount here, we went right down into this level here that's 50%, in case you're wondering why this did this. This little 50% line is half of this inefficiency right here from this candlestick's close and this candlestick's open. That's what I've highlighted and shaded. That's the suspension block. When you put the rectangle tool on, again, as I mentioned before, make sure it's top. Well, is it? It's not, is it? What is that anchored to then? Well, it's essentially the same thing. That's what it should be showing. I'm not sure. My eyes probably have it anchored to something else. But there it is. You can see that it's highlighted a little bit darker now. But this indicates that we're in a deep discount and we're inside of a daily old inefficiency and the market's traded down. And then now we can start studying price to see if it wants to give us a tip of the hand, kind of like show its cards to us by wanting to go higher. And that's going to be in the form of a market structure shift. You can see the bodies are respecting. We got a little bit of a wick in here. And then we have that short-term high formed right there, right on top of the low of this candlestick's premium wick. That's this candlestick's closing price. This short-term high, when it pierces through that, that's a shift in market structure. Now, to to get in the market there, that's a very high risk because you're basically trying to pick the low of a move. Try not to do that right now. Okay. Even for the folks that know a lot about what I've taught for a long time and my veteran students, there's nothing wrong with studying it and saying, okay, let's hypothetically say I'm going to do it there. That's what you should do. But don't go out there and start entering on trades like that, trying to get the best move at the lowest low. Don't do that. What I'm about to show you is how you should do it gradually, and that way your understanding will be comfortably graduated over time, not I expect to know how to do this right away in the first few times and I should be able to go out and make money with it, or it's bullshit and doesn't work. That's the consensus right now. That's what all these 20-year-olds or less, when they come here, they're so fucking stupid. They listen to other people's opinion, and because they don't want to do the work of themselves and watch what it is I teach and listen to what I'm calling out live and see if there's valid, useful information there or not, they subscribe to everybody else's opinion and they don't do the work to find out this is real or not. So by doing it this way, you will get all the evidence, all the confidence that what I'm teaching and divulging to you is privileged information. I'm telling you, if if you go back and look at everything that goes on in price action and you strip the charts like this, none of these moves are going to seem like they just appeared like an aberration. It's not going to be like that. It's going to be like, wow, it's always been there. And then when you look for things in a deep discount and you start looking for price to now start giving you bullish order flow. Okay. I saw a guy post the other day on Twitter or X. I can't call it X. It just sounds stupid. I don't know why they just keep it Twitter. Okay. It's Twitter. But he asked, like I get a lot of times in the comment section of the videos too, what do I think about level two? What do I think about volume profile? What do I think about ladders, DOMs, depth of market, that type of stuff? Or volume analysis. Okay. Before any of that stuff is ever referred to, I have this information. So, what do you think my opinion is? It's dog shit. It's useless. It's not, if it makes you feel like you're confident by using it and you've been profitable with it, hey, there it is. There it is, man. There it is. That's the thing that you needed to make you feel comfortable psychologically to take whatever catalyst or trigger that causes you to take a trade, because that's all that's necessary in the beginning. You have to have a way of calming yourself and not chase everything that pops up. And if you have a rule-based idea using that information and you think it gives you an edge, well, I'm not going to convince you otherwise. If you're making money, how could I convince you that you're not making money if you're making money? I'm just going to argue the case that what you're doing isn't making price go up and down. It's not the cause and effect. This is. Okay. So when price pierces above this wick high, why am I picking that one? Because after this low formed, it started going back over top of this lowest quadrant and it pierced a swing high in price. That's this candlestick right there. See that? So let me make it a little bit broader. There you go. So when it traded above it right here on this candlestick, we want to start seeing what? Bullish order flow. Algorithmic order flow has no requirement of any gimmicks, no level two data, no volume profile, no volume analysis, footprint. It's all bullshit. Okay. It's fucking bullshit. I can't say it plainer than that. Okay. Now I know somebody's going to come in and say, look at my broker statements. Look at what I did. Look at my did here. Look what I did. Okay, wonderful. That gets back to the same thing. You have a religion. You placed all of your faith in trinkets of deceit, because that's what that bullshit is. There's no different between that and RSI, Bollinger Bands, whatever. This is technical science. It's all time and price. Nothing else. There's no fluff in it. Time and price. That is it. When price trades above that swing high, we want to start seeing price do two things. Okay. Every down closed candle supports price. And I'll explain what that is in a minute. And we also want to see it respect the quadrants. Price goes above, the bodies come down here, but there's a little piercing on that candlestick right there, the wick, and right there. Where are the bodies? Are they above the lower quadrant, or are they allowed to go through it and trade below it? They're above it. Big, 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 big indication right there. There's no settings there. Where are the bodies? Are they above the lower quadrant, or are they allowed to go through it and trade below it? They're above it. Big, 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 big indication right there. There's no settings that you need to tinker with. No through it. The body supports price. And I'll explain what that is in a minute. And we also want to see it respect the quadrants. Price goes above, the bodies come down here, but there's a little piercing on that candlestick right there, the wick, and right there. Where are the bodies? Are they above the lower quadrant, or are they allowed to go through it and trade below it? They're above it. Big, 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 big indication right there. There's no settings that you need to tinker with, no optimization of my bullshit. The market's optimizing. You don't need to change any fucking settings on any indicator. The candlestick bodies are staying above it. So that's giving you the narrative that we are now in bullish order flow. Do you need a depth of market, volume profile, footprint, level 2 data? Do you need any of that horse shit to see what I just said right there? You can see it only in price track, the price charts. It's a time-based open, high, low, and close bar. You can't get that information from a range fucking bar, Ichimoku, and any fucking thing else that you want to contrive or construct. It's stripping the advantage. It's stripping it. I don't give a fuck how many schools of thought that you apply to your analysis. Elliott wave, fucking ratio trading, regular candlestick shit, Gann, Gartley patterns. You can keep throwing all the dog shit against the wall all you want. Something will stick eventually, but it's still going to stink the high fucking heaven because ain't no way that I would ever use that stuff. It's ridiculous. This is all that's necessary to understand what order flow is going to do. It tells you when it should start being bullish. It tells you how to trust that it's being bullish, how to identify it. The bodies are saying we're not going to go lower. So start watching down closed candles. Do down closed candles support price? Because that's my order block. My order block is not fucking orders. I have so many people on fucking YouTube literally running around saying, so yeah, because an order block is a bunch of orders. Bullshit! That is not what the fuck my order block is. That is not what that is. I specifically fucking taught it the very first time. It is not anything to do with orders. The word order is that it's ordering the change in the state of fucking delivery. Okay? That's the technical fucking term. That's exactly how I'm going to fucking say it in the book, with the F words included. It orders, it coordinates. It has nothing to do with buying and selling orders. Fuck you guys, man. You're stupid when you fucking out there creating your other extra bullshit. And whatever I taught, anybody that adds to what I'm saying, fucking drop them. Get their fucking asses out of your timeline. Don't even pay attention to them. Because I promise you, they don't know shit. They don't know anything. This is perfect. It's purity. It's perfect. And you start messing with it, you lose its perfection. Watch. Down closed candle right here. See that? What we want to do is visually represent, in my mind, I'm looking at that opening price and I'm carrying it to the right. Let me make it blue because it's going to not stand out. I want it to be popping on this chart versus the other black lines. It's very disorienting for me because I have all this shit on here, but I'm hopefully communicating this well to you. If this is making sense, I'm going to take a drink real quick. Let me know on X if this is making sense to you. If everything I've set up to this point right now, if this is making you understand a little bit more, let me know right now on X. Tweet to me, text me, say, hey, look, this shit's fire. We're probably gonna go for another hour. I don't know how many people are watching the live stream right now. It was probably fucking 3 people. I don't know. Man, I don't see anybody posting yet, so you're either sleeping or not watching. I'm just some guy who says, "Keep it coming. This shit's fire. Keep going. This is fire." Okay. All right, good. I got 3 people. That's all I need. 3 people. We have a party now. 2 things you have to primarily concern yourself with. Fuck the level 2 data shit. Fuck everything else. Fuck all your gimmicks. Okay. Everything you need to know is time and price. And by having these quadrants on your chart, or at least knowing what they are, then what you're doing is when there's a potential shift in market structure, how do you know it's a shift in market structure, Michael, and not just a retracement that's going to sell off later on? Watch. Watch. We're in a deep discount on the daily chart over here. This thing should, even if it's going to be a short-term bounce, it should at least make an attempt to rally outside of this inversion fair value gap. In and of itself, that's enough to take a trade. That'll give you 10, 15, 20 pips in pound dollar, euro dollar. Go and look at the charts. It'll be there. But looking at the down close candle, it's the lowest one, not just this one. This is lower. That's open is lower than that one. It has nothing to do with the number of orders. No buying and selling orders have nothing to do with this. That opening price is the change in the state of delivery. The order, the word order, is going to order, it'll create the systematic shift in price at that level, at that fucking price, that one. That's what you're looking for. When price is dropping down into it, like right here, okay? This candlestick's opening price is 98.143. And this candlestick's 98.142. It's off by 1/10. And it's the dollar index, which is shit. It's a market that's not real pure. Dollar's always got this weird, quirky bullshit to it. But when you use it with an index like NASDAQ or S&P or Dow or Russell 2000 or bonds or Forex currencies or currency futures, hello, hello. You're gonna see me trading some currency futures here before we get into Christmas. And I'm gonna use the same shit there. It ain't gonna be in Forex, it ain't gonna be in NASDAQ, it's gonna be in index only for right now. But I'm gonna do some currency trading with currency futures. And you're gonna see it's just as precise there too. It's not a one-trick pony. This stuff works in the DAX. Okay, it works in the FTSE. You know, stop emailing me and asking me these things I've already said before. It works in all of those things. It works there. I promise you. But watch what happens when it trades down into that. And then now what's it going to do? It orders what? The change in the state of delivery. The block of time. That's what the part of the word block is. Okay, that block of time sets and establishes the order in which price will change its state of delivery. That is the real definition of my order block. And find that fucking shit in any other Mickey Mouse stuff. It ain't out there, folks. It's not supply and demand. Ain't no fucking way this is resembling anything like supply and demand. Oh, it looks like supply and demand. That's because you're an idiot. Study it. You'll see. This is fucking light years. It's rocket science compared to marbles. You're playing fucking marbles with supply and demand. You're guessing. You have no idea what the fuck you're doing. Demand the fresh zone. There ain't nothing fresher than this. Piping hot and fresh. And then the market starts going higher. Now watch. We go above this lower quadrant. Okay. Big shift. Okay. Big shift is coming. Are we seeing price come back down to that quadrant level? Yes. Does it wick through it? A little bit. And that's permissible. But this candlestick, this candlestick, this candlestick, this candlestick, this candlestick, that is a block in time. You pay attention? Do I need to play some fucking rave music to get you hyped up now? Dance around, look like a fucking idiot. That opening price is the order block. That's the change in its day of delivery. That price, carry it forward. I'm gonna borrow this one. We rally a little bit up here, we fall short and start to break lower. This is the next draw, but it's going to drop back down into this order block. All of these consecutive candlesticks is one order block. Now, when you have a series of down close candles, you can go to the lowest one and be very, very restricting on your selection of setups. You're asking for the best of the best. There's nothing wrong with that inherently, but it just means that you're going to miss some setups if you're only and always doing that. But when you have a range of candlesticks like it is here, let me make it a little bit bigger and taller. Should be a little bit easier to see now. You're welcome. So by having that open on that candlestick down to that close here, here is mean threshold of this bullish order block. So at this price point or higher, and this none of this should seem hard. This is all basic ICT stuff from my YouTube channel. Like I'm not bending and twisting and contorting things to make it fit. But here is the upper quadrant, the mean threshold, the lower quadrant, and the low of that order block. All these consecutive down close candles. You have to consider the entire range. You can't just, oh, I'm going to only pick that one and expect to get every move. You won't. You won't get every move. And this is probably many times why you see these idiots on the internet say, "Oh, look at this! This is an order block right here. It never even went there. Ha ha ha! ICT's a fucking clown. Ha ha ha!" Dude, you're an idiot. Like this is what's going on. You grade it. You want to see it stay in what the lower half for um, the best responsiveness and price action. Do you want to see it appear in the lower half of it or in the upper half of it? What do I teach with order flow using my PD arrays? When it's bullish, we want to see equilibrium or halfway mean threshold. You want to see consequent encroachment or up to the high of the PD array. When it's bullish, you want to see sensitivity in there. And when it's bearish, you want to see it stay in the lower half. You don't want to see it traverse down into this area down here. And since we can measure this, watch, here's a qualifier for you. This is going for the people that ain't here really trying to learn, this is going to go right over your fucking head. But for the people that really want to know, I want to know that I know. Give me the details. I want to know every nook and cranny. Butter it all up. The open is right there at the equilibrium price point. So you're demanding it must go down halfway. What would happen if that opening price was down below that? It's even less likely it's going to trade to that as the order block. So now I just taught you when there's a series of candlesticks that make up an order block, how do you use the information? This is how you use the information. Don't buy my fucking book. Okay? Don't buy them. Don't buy none of my fucking books because I'm teaching you right here for free. Please stop listening to these fucking people saying I'm trying to get rich off of books. Why don't I have them out? Why don't I have them out there on the market right now? I'm hot right now because I don't need the fucking money. And this fucking publisher is arguing with me. I want my cover to look the way I fucking want. So that's where we're at. And yes, I'm being a dick about it. I don't care. But it's not that I'm teaching better than the book will, right here. So it goes down to the upper quadrant here, wicks down and touches the upper level of that inversion fair value gap. So we're getting two things. It's using the order block. It's staying in the upper portion. In other words, let me take the lines off. The bottom one off, that one, and we'll take one. So it's inside of this order block, it's this line and anything above. So this is the range right here. That's what you want to see it use. But it trades down and just touches the inversion fair value gap on the daily chart. So you're getting two pieces of information there. Yes, it's trading inside of this entire order block. It's permissible to do that. It could go all the way down to mean threshold, which is the halfway point at 98.171. And that's completely perfect. There's nothing wrong with that. What you don't want to see is the trade down in the lower half of that. In other words, below this on a closing basis, because then your probabilities of seeing a price run higher, it falls off precipitously. You want to see it stay in the upper portion of it, from mean threshold up when it's a bullish order block, from the low up to mean threshold, the lower portion when it's a bearish order block. Okay, so those rules are pretty straightforward. All right, so I can take this off now. All right, and then we get the change in the state of delivery. It rallies back up, falls short of getting up into this wick here. This is a premium wick, but you can grade that and carry it over here just to save time. You do that on your own, but you want to grade that, see how it's being utilized over here. And then it trades right back down into the, was it upper quadrant? I believe it is. Yeah, it's upper quadrant of this premium wick. Now, right away, I already see some of you think, oh, this is a lot. I'm getting confused. Okay, go trade with indicators, because if you want to see how I'm doing what I'm doing and you really want to learn, this is what I'm doing. And it's already going to filter out a lot of lazy people. And if that makes you angry, if I offend you, I don't care, because this is not hard. What I'm showing you here is not complicated. I showed you how to determine the range, and then you look for all the PD arrays and the wicks. Inefficiencies and wicks. It's the two first things I'm looking for. And they're obvious on your chart. Not every candlestick's going to have a wick. Not every candlestick's going to create an imbalance. So it immediately filters out all the bullshit. Only things that are salient, that's what you're looking for inside that 20-day look back. Market reacts, comes back down to the upper quadrant. Does it respect it? Yep. Sends it off again. Comes back down, wicks into it again, little tiny coloring outside the line, but watch the body. This body stopped here. We opened here, traded down. When it trades live and trades down like that, you want to anticipate it do this very thing here. And you want to see this candlestick or immediately the one following that. In other words, say this candlestick closed anywhere but below this black line here, the upper quadrant. If it closed anywhere like that, the next candle we would demand, okay, because I supply and I, I demand, respect for the stuff I'm sharing. That's the real supply and demand right here. The idea would be to expect the candlestick to start raging higher like that, because it's already showed a willingness to come down here a couple different times, and now it enters a macro. What time is that candlestick right there? Look at the bottom of your chart, or my chart. 6:50. Man, that's random. That is absolute fucking bonkers, man. The timing of that run off of that quadrant, after the shift in market structure, I taught you how to validate. You're in bullish order flow. All the things are sitting there telling you it's respecting the quadrants and down closed candles. Series of order block. Does it support price? Yep, it rallies. It's in it again here. It rallies off the quadrant, and then it tags it one more time, and now it's time to run. We're entering what time of the morning? 7 o'clock to 10 o'clock. That's the time of the day. I told you, every fucking day, it's going to lay it down on you. Here's the opportunity on a silver platter. Do you know how to find things are sitting there telling you it's respecting the quadrants and down closed candles, series of order block. Does it support price? Yep, it rallies. It's in it again here. It rallies off the quadrant, and then it tags it one more time, and now it's time to run. We're entering what time of the morning? 7 o'clock to 10 o'clock. That's the time of the day. I told you, every fucking day, it's going to lay it down on you. Here's the opportunity on a silver platter. Do you know how to find it? Between the last live stream I did, October 1st live stream, and today, you have now learned more than any fucking person can ever teach you about technical analysis. Candles, series of order block. Does it support price? Yep, it rallies. It's in it again here. It rallies off the quadrant, and then it tags it one more time, and now it's time to run. We're entering what time of the morning? 7 o'clock to 10 o'clock. That's the time of the day. I told you, every fucking day, it's going to lay it down on you. Here's the opportunity on a silver platter. Do you know how to find it? Between the last live stream I did, October 1st live stream, and today, you have now learned more than any fucking person can ever teach you about technical analysis. with precision that they could never dream of. You can literally piss in the cornflakes of everybody out there that says that you can't time the market. You literally can laugh in their face. Like, what do you call this? If this is not timing the market, what is it? This is exactly what everybody says is impossible. What the hell? So anyway, it rallies off the macro and then trades all the way up to that random level of, I call it this upper quadrant. It's lower quadrant. Excuse me, earlier back there. 98.306 is the equilibrium price point, or consequent encroachment rather, of the wick. Trades up to here. It comes right back down in. What's it doing right here? What is that? Buy side imbalance, sell side inefficiency, BISI, and watch. Order block. Changing the state of delivery. Carry the opening price over. It trades right down into that candlestick's opening price. Hammers it. Does it respect it? Yep. Do you have to look at a level 2 data? Do you have to look at the footprint to see what's going on? Fuck no, you ain't got to look at that garbage. Why? What do you need to have something else to distract you over? It makes you feel smart. That's what it is. See, this is elementary. This looks too, well, basic. Nobody's going to look at this and say, wow, man, man, you're Tony Stark of the charts. Look at that. Wow. I don't need gimmicks. You don't need gimmicks. You're here to make money. That's what you're here for. You want to learn how to time the market, go in here and find setups that yield itself to you, not waste your time with Mickey Mouse setups that don't work, using archaic language and theories that are fucking horseshit. That's why they don't come out here. That's why they don't tell you this is the candlestick it's going to run. This is the candlestick it's going to go to. It's not going to do this. It's not going to hit that level. It's going to stop at the 75 level. But those relative equal lows, Michael, I have to hold some things back. I wouldn't be ICT if I wasn't. So anyway, price sends it here, and we trade through the consequent encroachment level at 90, whatever it is at, 98.306. Right there, yeah. And then now watch again, we're above it. And it comes right back down. Are the bodies telling you that order flow is still bullish? Based on what I just taught you. Very simplistic language, very simple. When order flow is bullish, the quadrants and down close candles support price. In other words, treat that as your real support and resistance. That's the shit that really works. This is not in books. But I guarantee you, someone's going to take this video and create AI generated bullshit, and they're going to be on Amazon before the end of the weekend. And you're still going to be fucking wrong because I ain't giving it all in one fucking video. But does it support it? Yes, it does. Can you see it trade just a little bit above with these two wicks? Yep, and that's permissible. Why? Why is that permissible, ICT? Explain that to me, because I would be nervous if it was traded down here like that. Well, what is this? It's a fair value gap that's laying directly on top of that consequent encroachment level at 98.306. That's a high probability. Ready? High probability fair value gap. Yeah, TikTok fuckers. Yeah, you assholes. Want to talk shit and sidelines? The safety of the sidelines. It's proven it doesn't work. Really? It doesn't work in your hands. That's the only place it doesn't work. Because it works real good in mine. And for the people that are learning what I'm showing you here today, in the last couple live streams I've done, I have done a master class. I've literally pulled the fucking curtain down, and you see the wizard now. Okay? You're seeing him. You are seeing the maker. Okay? Here it is. The bottom line is that it runs right back up to upper quadrant at 98,000.402. Trades through it, fall short of the upper level at 98.499. That's this candlestick's wick high. And then it starts to retrace. Do you freak out? Do you lose your mind? No. Here's where you have a change in the classification of what is permissible and what's not permissible. When we are in the lower half or at consequent encroachment of this kind of wick on the daily chart, The lower portion of it, that's where the real pure you demand that the rules must be followed. They cannot deviate. They can't have any kind of, well, coloring outside the lines. It has to show you the support. The down close candles and the quadrants must be supporting. But when we get on the upper half up here, what happens is the price will and many times go into like this area of consolidation. Then you'll see stop hunts. You'll see using retracements that go below a short-term swing low, and then the real move ensues after that. But that will occur from consequent encroachment level up to the upper half or the high of it. That being this candlestick's premium wick. Okay, so from here, yes, from the consequent encroachment level of 98.306, this is a run that is favorable. But once it originates here, we shouldn't expect with any kind of fear that there's going to be retracements to that level after it's already done this type of parabolic run. But the retracements that occur in the upper quadrant, they can come back over top of that upper quadrant, even though it's listed as 0.25. It's because it's this level here. Bottom line is it trades down through it and then back above it and then rallies up to the high here, then back down. Now, this is the stop hunt I was telling you. It's always going to occur in the upper half. Here's consequent encroachment. Think about if it's going to move, chasers are going to see, oh wow, look, it's running now. Dollar's probably bullish. And they retrace it. They lay a trap down. They show a breakout above this old high. They're not using this quadrant level. They're looking at this high being broken out to the upside. And then they see a bull flag. They say, wow, I'm going to keep adding there. And then they shit the bed and come right back down for their stop in the upper half. How does ICT know when they're going to do a stop hunt? How does he know when it's a market structure shift or just a stop hunt? I just showed you. By having these ranges graded, it pulls back the veil and shows you exactly what it is that you should understand about what's permissible and what's not, what should and shouldn't happen. Now, if you're brand new, if you're really, really new to my stuff, this is going to feel like it's over your head. But for the folks that have been with me for years, you have now literally been jumped forward light years ahead in understanding. Like this is like Viagra for a technical analyst. Like you are fired up. You're running around with wood right now. And ladies, out of respect, you're just happy. Let's put it that way. Stop hunt taken. Supporting at a quadrant. Yes, we wick down through it. Why is that permissible? We're in the upper half of a bullish order flow. Volume imbalance. That's the only inefficiency. Why am I not able to see? There you go. I'll say I paid my bill, man. What's going on? The volume imbalance right in here. You can see it trades right down to that little inefficiency right there. It doesn't need to go below that low. For the folks who are saying, why wouldn't you be afraid it's going to go below that? Because it's already done that. Right there. That's the stop hunt in the upper quadrant. There's the little stop hunt. Boom. Leave a volume imbalance below the quadrant level. Rally. It gets a little muddy in here. They use this inefficiency here to send it right back down just to get that volume imbalance and scare anybody else that maybe has a stop loss here or they think this is a big bear flag. And they would chase it going lower. And then it resumes back to supporting the quadrant. And now watch, we have another run away from it. After it's done this only inefficiency down here, we go back to looking at the order flow with the order block. Down close candle, opening price, draw it out. Is it supporting it? Is it staying in the upper half of that? Yep. Rally. And it runs up to the high of that wick again. So now that was a very, 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 very long discussion, hopefully fruitful. Hopefully it answers a lot of questions. I'm sure for some of you that are brand new, you have a million more new questions. And that's good. I want you to have questions because that means you're going to go into my content and you're going to study. Or You're going to listen to me when I post stuff on Twitter, and you're going to say, okay, what does he mean by mentioning that? Let me go in here and use this information. And it's going to be suddenly interesting how all of a sudden you can catch up to what I'm saying. Why didn't you teach this from the beginning? It would have been so much easier. Yeah. And I have more people than I have all around the world ripping me off. I'm making millionaires, not only in trading, but I'm making millionaires because they're teaching my shit and saying that they found it themselves and changing the names of it. I'm not guilty of that. They're the one rebranding, but they can't do this. I promise you, they'll show all their trades in the past, and it won't line up with this logic. It'll just be lucky they got here and there. And you'll see when they failed, it was not using this. But they'll never do that. They'll never share that stuff. So anyway, that's the business. We can finally move over to Euro real quick. I'm not going to do all this on Euro because we'd be here all day. But a bullish